Hey y'all, it's been about a full year since I put up my 2022 trading lessons video, and man, what a year it's been. So much has happened, and I wanted to provide a quick summary of all the ups and downs I experienced in 2023, as it'll provide some context for how I gained the trading insights in this video, and hopefully make them more credible. The first big change in 2023 was that I stopped trading with ICT concepts because I found that trading his 2022 setup using a set of mechanical entry rules was just not long-term profitable for me. I started taking the Brooks trading course because I found Al Brooks's price action concepts to be more straightforward and easier to understand. While getting through the Brooks trading course, I traded Apex eval accounts using Mac's two-legged pullback strategy and had decent success with it when combined with a strict one-to-one reward to risk requirement. I actually passed a bunch of evaluation accounts using a combination of two-legged pullbacks and Al Brooks's always-in entries that followed major trends, and decided to use the same trading plan on my PAs using a trade copier. I started with 16 PAs and unfortunately went on an absolutely brutal downswing, losing 7 of these PAs before I finally accepted that this strategy was also not long-term profitable. The only silver lining during this downswing was that since I was following a very mechanical trading plan, losing trades didn't put me on tilt too much, and I was able to follow my risk management rules, which actually helped improve my discipline. I was also logging all my trades using TradeZella, and found that many of my losses were from the two-legged pullback setup, and I was actually net profitable when trading the always-in entries that chased momentum. This data made me decide to abandon the two-legged pullback setup, and I started refining my own personal setup that made sense from what I personally observed in the markets, which I named Liquidity for Grabs, or LFG for short. While I was forward testing the LFG setup, I also decided to try out an automated trading bot that was designed to capture momentum and turned this into a man vs machine challenge to see if my LFG setup could outperform the trading algorithm. Well, the month in which the challenge took place had overall choppy price action with very few trend days, and it wasn't a surprise that the trading algorithm setup, which relied on strong trend days, performed very poorly during the month. Seeing the trading algo's failures taught me that it doesn't make sense to try to force a single setup in the market that's constantly changing. This is why it's so hard for retail trading algos to be profitable in the long term. And I actually realized that this was exactly how I'd been trading myself. Whether it was indicator-based setups, ICT setups, or two-legged pullbacks, I had always tried to only trade a single setup with objective entry rules and minimize discretion as much as possible. This was because I had found that it was just so easy to go on tilt after taking losses from discretionary trading, and at times it was hard to tell the difference between discretionary trading and tilt trading. However, my man vs machine challenge taught me that trying to force a single setup onto a dynamic, ever-changing market just isn't long-term profitable, and so I decided to trade my remaining 9 PAs again, this time sizing down to micros and incorporating more discretion in my entries and exits. Well, this adjustment, combined with my improved discipline from following my risk rules during that brutal downswing, and probably a little bit of luck, completely turned my trading around. I started trading my 9 PAs again around the end of September, and for the next 4 months, my trading was the most consistently profitable it's ever been. I didn't stick to a single setup, and instead used discretion to trade various setups depending on the type of price action I was observing, all while sticking to my risk rules for the most part. I still made psychological mistakes during this stretch, as there were days where I broke my risk rules and took big losses, but overall I felt like I leveled up as a trader and finally got a taste of what consistent profitability was like. Using a copier for leverage, I was able to withdraw a total of $13,000 from these Apex PAs in 4 months, which was great, but what made this even better was that I documented my P&L, account balances, and withdrawal requests in my community tab every single day while I was trading these PAs for full transparency. I also documented everything else I mentioned so far, all the ups and downs of my trading journey, on this channel, partly for my own accountability, and partly to show everyone that for retail traders like me, achieving consistent profitability is extremely difficult, but not impossible. I know most of y'all watching this are retail traders working towards consistent profitability yourselves, and so I wanted to make this video to summarize the biggest trading insights I gained in 2023 that helped me make the most progress towards consistent profitability, and hope my own observations can help y'all in your own trading journeys. To start, I wanted to quickly go over my thoughts on the concept of technical setups and why they're a bit of a paradox when trading. Many of you might not agree with me on this, but I personally believe that price action is inherently random. And yes, I know ICT says there's a secret market algorithm, and I think that's complete BS, but won't get into that right now. When we think we see repeating patterns on the charts, it's because we're looking for them, and are unsuspecting victims of confirmation bias. This is why you might have found that technical setups appear to be great when you backtest them, but when you actually try taking real trades with them, they don't seem to work as well. Technical setups themselves don't have any predictive power, because every instance of the market is unique. I learned this the hard way after going on that brutal downswing from trying to force the same technical setup every day. This is why I'm not going to recommend any specific technical setups in this video, and why I think videos that claim to teach high probability technical setups are simply clickbait and are not helpful. In my opinion, the primary value of any technical setup is that it puts structure around a trade thesis and gives us a reason to enter the market. Without technical setups, we would just be entering the market randomly, which is something our rational brains can't allow us to do when there's real money on the line. I actually prefer simpler setups that are easy to identify because it gives me clearer entry opportunities. The paradox with technical setups is that when we decide whether to put on a trade, we have to simultaneously believe in two things that appear to contradict each other. One, that the market is inherently random and that our technical setups have no predictive power on their own. And two, that if we take the same setup enough times, we can actually be profitable over the long term. But how can any setup be profitable over the long term if the market is inherently random? The missing piece to this puzzle that can resolve this contradiction is intuition, which I view to be synonymous with discretion. Intuition, or discretion, is what I believe to be the first of two keys to consistent profitability. It's that voice in your head that sometimes tells you not to take the trade, even though all your requirements are met, or to take the trade, even though the requirements of your setup are not fully met. Assuming the market is unpredictable, if you stuck to your technical setup without any deviation whatsoever, you would theoretically just break even in the long run. But using discretion to modify your setup and being right more often than not is ultimately what makes a trader profitable in the long run. The better a trader's intuition, the more their discretionary choices are correct, and thus the more profitable that trader becomes. In my 2022 trading lessons video, one of my lessons was to make your entry rules as objective as possible and not to deviate from them. Well, my experiences in 2023 has taught me that this makes you no different from an automated trading algorithm, and it's very difficult to achieve long-term profitability without discretion. So the question now becomes, how do we improve our trader intuition, or in other words, get better at using discretion when trading? I'm honestly still trying to figure this out myself, but so far I'm realizing that there's no way to do this other than to simply get more experience being in live trades with real risk. Taking trading courses, consuming trading content, backtesting strategies, and trading on sim accounts, of course have their own value, and all beginners should start there, but these are by no means shortcuts to becoming a profitable trader. I believe that your brain only truly internalizes how the market moves through first-hand experiencing the range of emotions when using discretion to manage a live trade, and feeling the thrilling wins and soul-crushing losses. It's a slow and frustrating process, especially since you'll take many losses along the way, but letting yourself follow that voice in your head guiding your trading decisions, whether on a live account or prop firm account, since both have real risk, is the only way to improve your trader intuition. And you'll find that over time you'll start making the right decisions more often than not. This is what I observed firsthand in the second half of 2023, where my profitability very noticeably improved when I stopped sticking to a single setup and started incorporating more discretion into my trading, ultimately resulting in 4 months of consistent withdrawals totaling $13,000. While I learned that discretion is essential to consistent profitability, I realized it was a double-edged sword, as the more discretion I used in my trading, the more tilting my losses were. When I was trading very mechanically using a single setup, losses were very easy to accept because I had no choice but to take my setup when it presented itself, and so if it didn't work out, that's just the unpredictability of the market. However, when using more discretion to manage my trades, losses felt like they could have been avoided if I had managed my trade better, which made them more upsetting and tilt-inducing. Even winning trades could be tilting if I used discretion to exit for a small profit and it continued running without me. I had stuck to my risk rules so well when I was trading mechanically, but once I started incorporating more discretion, I found myself breaking my risk rules more often, usually leading to big red days. This leads me to what I believe is the second aspect of consistent profitability: discipline. Discretion without discipline is not enough to be consistently profitable, as I'm sure we've all experienced how big of a setback a tilt trading spree can be. Tilt trading, which I view to be the same as revenge trading, usually results in a big red day, wiping out multiple green days or even blowing accounts. You need both discretion and the discipline to prevent tilt trading to achieve consistent profitability. Now, while improving your discretionary trading skills can be a bit abstract, the good news is that trading your discipline seems to be a bit more tangible. and I wanted to provide some actionable tips that personally helped me train my own discipline over the past 2 years. My first tip is to set risk rules that are specifically designed to prevent yourself from going on tilt. We all have unique personalities, which results in us having different trading styles, different risk tolerances, and different triggers that cause us to tilt trade. So we each have to determine what sort of risk rules make the most sense to us personally. For example, I found that in my first year of trading, losing 2 trades in a row put me at high risk of going on tilt. So I set my personal risk rule to stop trading after taking 2 total losses for the day. As I became more experienced, I found that 2 losses wouldn't bother me as much, and I increased my trade limit to 3 losses per day. Some traders may just limit themselves to 3 total trades per day, win or lose, and other traders may use P&L dollar thresholds to decide when to stop trading. No matter what type of risk rules you use, every trader needs a concrete way of setting a limit to how many trades they can take in a day. Day trading, especially when using discretion to manage your position, is so mentally taxing, and personally, I found that the more trades I take in a day, the worse my performance gets, and the more likely I am to go on tilt if something triggering happens. So incorporating some sort of daily trade limit into your risk rules is necessary to help prevent tilt trading. Unfortunately, no matter how refined your risk rules are, something unexpected will inevitably happen which will make you break your rules. I honestly think even the most experienced day traders are still susceptible to tilt trading, because as humans, we just can't turn our emotions completely off. Which brings me to my second and possibly most important tip, which is to set up a hard lockout when your daily loss limit is reached. This is basically a failsafe, where in the off chance you go on tilt and break your risk rules, your trading platform will automatically lock you out if you hit a certain daily loss threshold, and physically won't let you take any more trades until the next trading day. I use NinjaTrader Brokerage for my personal features account, which has these hard lockout risk settings, but I'm sure other brokerages should have something similar. For those trading with prop firm accounts, you can set up daily max loss limits in Rhythmic Trader, where it prevents you from trading after hitting a defined loss threshold. Unfortunately, it's very easy to remove this soft lockout and keep trading after you hit your loss limit, but I still recommend setting this up because it's still another barrier that can potentially prevent you from making the damage worse. There's also a third-party app called Guardian Angel that integrates with the NinjaTrader platform, where you can configure risk settings to set hard lockouts that can't be easily removed. I haven't used this myself, but I've heard good things about it. Anyway, during the 4 months of my consistent withdrawals from my Apex PAs, there were at least 6 days where I went on tilt, broke my risk rules, and ended up hitting my rhythmic loss threshold, which locked me out of trading. I really believe that had I not set this loss threshold, I would have blown my accounts all 6 times. And these lockouts might be the biggest reason why I was able to withdraw as much as I did. So I'm really not exaggerating when I say that everyone needs to set up hard lockout parameters within the trading platforms, because they will absolutely save your accounts from getting blown. Again, this should be viewed as a failsafe if you go on tilt and ignore your normal risk rules. I wouldn't recommend only relying on this lockout, because I think there's a lot of value in following the risk rules you set for yourself and stopping trading before the lockout happens. In fact, the more you're able to follow your risk rules without going on tilt, the more your discipline grows. Tip number 3 is for when you're finding that you keep breaking your risk rules. This usually means that taking losses is affecting you too much, as they're causing you to go on tilt and ignore the rules you set for yourself. If you can relate to this, my advice is to continue to lower your risk per trade until you can consistently follow your rules. Losses are always going to hurt, but they don't have to put you on tilt. And I found that the most direct way to make them less tilting is to make them smaller. Whether this means trading with fewer contracts or switching from minis to micros, trading with smaller size will generally make it easier to follow your risk rules. Of course, this applies to live accounts, but I think sizing down is especially important for prop firm accounts with trailing drawdown thresholds. Many prop firms intentionally let you trade with big size because they know that the market's unpredictability creates a lot of variance in trading results, and it's very easy to blow your account after taking a few losses, especially with the trailing drawdown. The smaller size you trade, the less the trailing drawdown becomes a consideration. Not only is this easier to stay in individual trades for longer and not get chopped out by noise, but you can also survive longer downswings, which can and will happen to all traders. This will make it more likely for you to keep your prop firm accounts alive long enough for withdrawals. I believe that the best way to manage drawdown on prop firm accounts is to trade extremely small size per account and use a trade copier for leverage, which is how I had the most success trading my Apex PAs. For my last tip, I wanted to share some psychology mindset shifts I made that personally helped me build my discipline and not go on tilt as much. First, the reward to risk ratio of any single trade is inversely correlated to the probability of winning that trade. It's just math. If you're going for a 2R trade where your profit target is 10 points away and your stop loss is 5 points away, it doesn't matter what your technical setup is, it's just mathematically more likely for you to get stopped out. In fact, statistically, your chances of losing a 2R trade is twice as much as a chance of winning it, since it's a 2/3 chance you lose versus a 1/3 chance you win. Internalizing this simple math makes it easier for me to accept a loss when I'm going for 2R. You have to view each trade you take as its own unique occurrence and think in these probabilities, while trusting that the long-term edge of your trading plan will result in net profit after 100 trades. Going back to the same example of only taking 2R trades, you just need to win more than 33 trades out of 100 to be profitable. I think this is why psychologically, for me at least, if I go for more than 1R on every trade, losses are easier to accept, which goes a long way in preventing tilt. In addition to being able to accept losses, we also need to be able to accept wins, which sounds strange, right? I find that whenever I go on a hot streak where I'm winning far more than I'm losing, I become more confident when putting on trades, which is a good thing. But it can put me at risk of becoming overconfident, where I subconsciously start expecting to win trades. Once this happens, taking a loss, or God forbid multiple losses in a row, has a much higher chance of putting me on tilt. Being aware of this and attributing our hot streaks to luck rather than thinking we are trading gods who can predict the market goes a long way in keeping us humble and less likely to go on tilt when the inevitable downswing hits. I'm saving the most important psychology mindset shift for last, which is to redefine what a good trading day is. As I mentioned before, the best way to build discipline is to develop a habit of following your risk rules, so you have to make following your rules top priority, and yes, even higher priority than making profits. A good trading day should not depend on what your P&L looks like that day, but rather it should depend on whether you followed your risk rules. If my risk rules are that I have to stop trading after 3 losses, and I lose 3 times in a row, and actually stop trading, that's a good trading day. If I keep trading after hitting my 3 loss limit, and am able to tilt trade my way from red to green, that's actually a bad trading day. Breaking your rules can hurt your discipline, especially if it works in your favor, because that subconsciously reinforces these bad habits. Without discipline, you'll find yourself continuing to tilt trade, which may lead to some profitability in the short term if you get lucky, but undisciplined trading is simply unsustainable over the long term because you'll inevitably blow your accounts. By redefining what a good trading day is, we can prioritize following our risk rules above everything else and build good trading habits that minimize the risk of going on tilt. This discipline, to me, is ultimately what makes consistent profitability achievable. So there you have it. The biggest trading insights I gained in 2023, which can be summarized into 2 words: discretion and discipline. These 2 skills are what I believe to be the keys to consistent profitability, and both are mandatory. Disciplined mechanical trading, without any discretion, is the same as automated algo trading, and you just can't be profitable in the long run without adapting to changing market conditions. Discretionary trading without discipline is just gambling without any risk management, and also just isn't sustainable in the long run. There does seem to be an inverse relationship between discretion and discipline. The more discretion you incorporate into your trading, the more tilting losses become, and the harder it will be to stay disciplined. It's a delicate balance that varies from trader to trader because we all have different personalities. So it's up to you how best to incorporate discretion and discipline into your own trading. Hopefully, this video has shown how I was able to improve both my discretion and discipline, which was a huge step forward in my own trading journey that led to the consistent withdrawals from my Apex PAs. As for what's next for me, I'm planning to work towards replenishing my prop firm funded accounts and try to submit even more withdrawals in 2024 than I did in 2023. I actually recently passed my 25k TradeDay evaluation, so we'll try to grow that nice and steady while trying to get to 20 Apex PAs, which is their maximum. Apex and TradeDay are the only 2 prop firms I trade with currently. I've had positive experiences with both of them so far, and would recommend them to anyone looking to trade with prop firms, which is why I'm only affiliated with them. You can use my affiliate links and coupon codes in the description to get the best available discount on Apex and TradeDay accounts, which also greatly helps out this channel. As another way to thank all of y'all for your support and for making it to the end of this video, I'm giving away 3 50k TradeDay evaluations that each retail for $165. To enter this giveaway, all you need to do is just leave a comment on this video and I'll be announcing 3 randomly picked winners on March 1st. If you found this video helpful at all, would also appreciate a thumbs up, and please consider subscribing to the channel. I've been mainly uploading trading session recaps, but I might start creating more educational content about trading concepts, psychology, and prop firms, because I think that might be more helpful. One thing I can promise you is that my content will be as honest and as real as they come. I'm not claiming to be an amazing trader, and I'm not selling anything. I'm just a retail day trader documenting his journey towards consistent profitability on YouTube and sharing the lessons I'm learning along the way. I have no idea what 2024 has in store for me, but let's find out together.